Now we are seeing this digital revolution happen. More and more people are not only banking online, they're working online. Have they become more vulnerable? And if so, have you had to raise your cybersecurity spending? How are you doing on that front?
Well, clearly, cybersecurity is number one in our risk maps. And we've spent a lot early on because we've started our transformation journey over 8 years ago and accelerated it 4 years ago. So going into this pandemic, clearly we have our cybersecurity infrastructure in place. The dimension that it adds in terms of risk is that the increased connectivity on both sides, the work from home workforce and the customer side, requires us to be a little more vigilant in terms of device protection and as well as protection of the communication network that connects us to our customers and us to our team members as we serve this customer base. So clearly, that's an important thing. It'll become even more important in the future, but we're ready and we've made the investments already ahead of time.
Does that mean that you're not expecting a rise in costs on that front, at least not in the short term?
I think it will be a bigger cost going forward, but at the same time, as a result of the pandemic, we've increased our operating leverage, and I think that's the same for most mainstream banks in terms of doing a little bit more of right-sizing to the market. We have a lot of productivity gains in terms of technology investments. And at the same time, we expect that the increased competition and the adoption of digital by customers would actually expand the market, especially in emerging markets where you have a huge 70% that are unbanked or underbanked. So yes, cybersecurity investments might increase, but that will be offset by other gains so that I don't expect that our operating expenses would actually increase disproportionate to the growth in our revenues. On the contrary, I think our margins will improve.
Let me ask about your loan book. How's that looking? How's demand looking? Have you seen a rise in NPLs and a deterioration in credit quality given the pandemic environment?
Yes, we have. And we've used the judgment calls that were allowed under our ECL models to basically do a macro look. So many of us banks, at least in the Philippines, have provisioned ahead of the curve. But we still expect peak credit stress probably in the second quarter of 2021, and we're preparing for that. So clearly, we're well capitalized. The industry is profitable. The loan book has shrunk, and I think this is very consistent with the destruction of demand, and hopefully that will be offset based on the different calculations or forecasts that we'll have growth in 2021 and even more growth in 2022 as we recover from this pandemic. And so you know that the loan book is clearly very dependent on GDP growth, and we expect that next year. But our loan book has shrunk.
How much of a jump then do you see in provisions in the last quarter of this year and first quarter of 2021?
Well, we ourselves are provisioned for the year. We're already done for 2020. We expect maybe 1/2 of the provisions that we made in 2020 into 2021. But we do update our expected credit loss models on a monthly basis. And we set up provisions monthly, and that's what we will continue to do in 2021. We don't expect it to be difficult to achieve given our current balance sheet strength, our capital strength, and the continued profitability of the business.
You had a peso bond sale last week. When are you expecting to go back to the debt markets, either domestic or foreign?
Well, I think not in a while. I think we've very much done with trying to create a better matching of our liability and our asset books. And we've accomplished that both on the foreign currency book and on the domestic book. But what was interesting about that latest bond sale, which was 3 and 5 year, is that we worked and co-developed with SC Ventures, which is a Standard Chartered Bank, to do this on a blockchain model within a regulatory sandbox approach with the BSP, our Banco Central, central bank, and the Securities and Exchange Commission. So it's a mirrored transaction. We had digital ordering book. We tokenized the bond, but we didn't actually issue it to the investors. We issued them traditionally, and we have our back end also on the blockchain. So that's what's interesting going forward, because that will democratize the bond offering, expand our investor base, and even allow foreign offshore Filipino workers to participate in this sort of bond offerings. But right now, we don't have any plans to do new ones in the future.
The democratization of the bond market, that's really interesting. Just very quickly, we've seen a lot of disruption, a lot of dislocation this year. What are some of the trends that have arisen in this pandemic that you think will be permanent changes?
Well, I think the biggest trend will be competition. We're seeing that the regulators are giving out digital bank license. Our own regulator has just come out with its circular to do so. We're seeing the tech fins and fintechs separately from applying from digital bank license coming into our marketplaces. And we're looking forward to the high probability of open banking regulations. But like I said, so that greater competition, I think, is going to stimulate the growth of the market, even at the same time that it creates tension between the different participants, simply because we have a huge unbanked population. And as GDP growth comes forward in the future, we feel that this will be a great opportunity space.